All right, good afternoon, everybody. Welcome to the ATBS Independent Contractor Benchmarking webinar update for drivers for the first half of 2019. I'm so glad you all could join us. We made a change because we got some feedback after our last few webinars. We had been doing them in kind of the mid-morning time, and a lot of drivers said they were driving and busy and in traffic, and they really couldn't listen. And so we moved to the afternoon, and hopefully that gives you a little more time to listen in and hear what we've got to say today. I know most of you are not able to sign in via the webinar and watch on your computer and see the slides. You're listening on the phone. The good news is we're recording this, and so we'll make it available to you. We'll email it out to everybody that registered probably sometime by tomorrow afternoon after we get the recordings all put together. So if you missed something or you can't take notes or you want to see the slides, rest assured you'll get them. And with that, we'll go ahead and get started with the webinar. We have boy, I think 600 or 700 drivers that have signed in and listened to the phone call. So that's fantastic. We look forward to giving you all some insight on what's going on with the market right now and where things stand. My name's Todd Amon. I'm president of ATBS, and most of you probably know who ATBS is on the line, but just in case you don't, we've been in business for 21 years. We work for independent contractor truck drivers. We do their books, their taxes, and most importantly, we spend a lot of time helping advise our customers on their business and how they can maximize their income and minimize their taxes. So I look forward to going through some information with you today and helping you see where things are at. So I'm going to start off really by talking about some specific data, and I guess as we get into the numbers, I want to help you understand our perspective. We work with about 20,000 contractors at ATBS, and the neat thing about our business is that even though we work with contractors from all over the country and in every segment of the industry, from gravel haulers to over-the-road dry reefer and flat to folks in the oil fields and expedite, everything you can imagine that moves via truck, we work with contractors in those segments. But at the end of the day, being in the accounting business, we can take those gobs of receipts and some of the information and put that in consistent format so that we can kind of compare all those businesses together. So we've been doing this now for about 15 years, and so the really fun and awesome thing is we've got some great trend information that we can talk to you about, what's going on. So I'm going to start off. I imagine we have quite a few folks that have been on our calls before, and we like to, at the beginning of the year, we do a webinar or a phone call like this, typically in March, to talk about the previous year. At that time, we make predictions about what we think is going to happen in the coming year. And I want to run through those predictions real quick just to see if we're on track with what we thought was going to happen at the beginning of this year. I think all of us coming into 2019 had a pretty good idea that we were coming off of a, really a record 2018. Things were fantastic. They're just really, things couldn't have gone much better in 2018 for our industry and for owner operators. Everybody made, good money. The freight was abundant. Fuel was reasonable. Things were just really good. And so really kind of what we knew was we had had about a year and a half of record manufacturing of Class 8 trucks. The order boards were crazy. Fleets were adding trucks. The used truck market was robust. And, so our industry, as we typically do, we added too many trucks during the boom time. That's what we always do in trucking, unfortunately. So, just to keep it in perspective, what usually happens in trucking is we'll have 18 to 24 months of good times, meaning things are great for truckers, rates are good, freight's abundant, and then we'll get overzealous and we'll add too much capacity, and then we'll have 24 to 36 or more months of downtime when things are not so good for truckers. That's just assuming we have a normal economy, assuming we don't have a really bad recession like the Great Recession or things like that. So we're kind of in one of those times where we're coming off of 18 to 24 months of good times in trucking, and we're probably heading into a bit of a slower time. I'll talk a little bit. I don't think we're heading into a deep, dark recession. I just think we had too many trucks last year, and so things are a little bit more difficult this year. That means rates have come down, and there's more trucks looking for those loads. So you're competing with more people. One of the end results of that is one of the predictions we made is that we will have what we call a flight to quality. And so, I'll talk in a little bit in more detail about this, but what happens in a really robust market is a lot of those independents that operate under a contract scenario, meaning they're driving probably under a fleet, those drivers go out and they run the spot market. They get their own authority and they go out there and they run load boards because the rates are incredible and you can make a lot of money. And then we had a time like now when the spot market rates, plummet because there's too many trucks out there, and those folks that are in the spot market that don't have a true head haul shipper contract, they're not making money. They're struggling based on what they did last year, and so they look for a safe home. They look for a shipper. They look for a carrier that can provide them consistent, albeit lower paying but consistent good freight. So that's what's going on right now. A lot of you out there probably that had a great last couple of years, made good money. You're struggling right now and you're looking for a place to land. So one thing that I think is important to remember is 2018 was a year like no other in trucking. We were able to raise rates as an industry, more than we ever have in the past. In a typical good time in trucking, we will raise our rates as an industry, 3 to 5% when things are really pretty good. Last year, we raised rates anywhere from 12 to 20% from a contract rate basis. That's not the spot market. That's just a long-term shipper relationship. We were able to do that because the ELD went into effect, which limited capacity, and we had a robust freight market and a lot of other things last year allowed us to raise rates higher than we ever have before. The good news is, even though this is a more difficult year, and shippers are putting pressure on carriers, they're not putting enough pressure to eliminate those 12 to 18% rate increases. They're able to put enough pressure on to reduce a few percentage points. So the good news is we're not going back to where we were before, which is a great thing because our costs continue to go up. Trucks are more expensive, fuel costs a little bit more, insurance for sure costs more. So all things are more expensive, maintenance is more. So the good news is we've got higher rates to offset those increases. The fourth prediction we made was that net income is going to flatten out for our clients in 2019. 2018 was a record year. On average, our clients in 2018 made $65,000 of net income. That was up from $60,000 in 2017. So it was a really nice jump. And, we figured this was a year that was going to moderate with the industry slowing down. And we've seen that, but not too terribly. And so one thing that we started talking about early in the year, for sure on this presentation that we did back in March, but every day with our clients, is it's important this year to focus on the cost side of the business. We kind of lost track of the cost side last year because last year was such a great year. It became all about the revenue. So I'm going to dig in deeper on that. But just remember today, in 2019 and, really for the next little while into 2020, it's important to focus on the cost side of the business. And the last thing really that we predicted was that the owner-operator lease purchase programs would continue to proliferate in our industry. During the kind of Obama administration years, there was really a pretty severe attack on the independent contractor model. Not that that's gone away. You probably have all read and heard about Bill AB 1 or AB 5 out in California right now that's likely to pass. That's a blatant blight attack on the independent contractor model and is seeking to outlaw the independent contractor model in California. Not just for truckers, but for Uber drivers and Lyft drivers and people delivering food and everything else. Maybe we'll talk a little bit more about that near the end, but the good news is that was pretty common, not just in California, but across the country, 3 or 4 years ago. Today, that has really done a 180. And, because truly at the end of the day, every one of you that has your own truck does it for a reason. You want to be your own boss. You want to run your own business. You don't want to be an employee of the truck line. And so the good news is, we're back in a mode politically that it makes you able to do that. So I'm going to spend just a second talking about the different types of owner operators because I know we've got all kinds on the phone, and I'm going to talk about kind of the career path for a driver. When you get into this industry, you start out as a company driver. You go to truck driving school. You learn how to drive down the road, back into a dock, be safe, and you do that for a while. A period of time, period of miles, period of years. And then at some point, many of you choose to want to take the next step in your career and you want to be your own boss and you become what we call a pioneer. The easiest way to become an owner operator, for the last 30 years, if you don't have great credit, you don't have a lot of money to put down, is you go out and you lease a truck through a fleet. Oftentimes that's a no money down deal. You can get a decent truck out of it and it's fairly low risk. We call them pioneers for a reason because it's a pretty high risk game. I mean, you've got to be good at it to be successful. And many of you have done that and you have been successful. And over a period of time, you save up money and you say, you know what, I love leasing the truck from the fleet, but I really want to take the next step in my career. I'm going to get my own truck. I want my title on it. I want the depreciation benefits. And so you go out and put money down, you borrow money from a bank or a finance company, and you go out and get your own truck. But you still like the convenience, the comfort, and all the benefits that come along with being leased onto a fleet. And so you still operate under a motor carrier. You get buying discounts and those kinds of things. About 2/3 of the owner operators in America are either pioneers or hired guns, meaning that they operate under the fleet authority. And then we have a year like last year, and we have a bunch of what we call lone rangers that are created. So operated under that fleet, things were nice, but I heard my buddy talking on the truck stop, or I looked on the load board when I was on a layover, and I saw, just looking at the load boards, $3 plus per mile freight, and you said, man, I think I can make a bunch more money being in the business for myself. So you go out and get your own authority, you get a trailer, you get your own insurance, and you go out and do it on your own. You become a lone ranger. And some of you, over a period of years, save up enough money, you're successful enough, you go buy that second, third, fifth truck, you become what we actually call a trailblazer, and you own your own small fleet, and you're running your own truck line. That's how some of the largest truck lines in America were born over the last 30 or 40 years. They started with one truck, and today they have thousands of trucks. So, truly it's a pretty awesome story for those that go all the way through the driver career path. But many people stop at some point when they feel like they don't want to work harder, do more, take on more risk. You may stay a pioneer forever. You may be a company driver forever. You may be a hired gun. You may be a lone ranger. So just to set the table, because I'm going to talk about each one of those different kinds of owner operators as we go through the presentation. So one of the great things that we get to do at ATBS here is, in addition to the 20,000 independent contractors that we work with as individual clients, we get a lot of our customers through partnerships with truck lines. And so we also do webinars for the truck lines to kind of help them understand what's going on in the industry, what's the mentality of the drivers or the owner operators, making money, losing money, doing okay. The good part about doing that is really our goal is to raise the bar for all owner operators, make sure that our partner fleets have good, fair programs where owner operators can make money in them. And so as part of that, we do webinars for the fleets. And we actually did a webinar yesterday. We had, a couple hundred fleets representing probably close to 75,000 owner operators on the webinar. And because it's interactive, we can ask them poll questions. So one of the questions we asked yesterday was, do you plan to add independent contractors to your fleet this year? We've asked that question all the way back to 2015. And as we went through the years and got into 2018, we moved into a pretty high growth mode, as we've already talked a little bit about. Over 50% of the fleets on the phone said they wanted to add 10% or more owner operators. 20% of those fleets said they wanted to add more than 20% owner operators to their fleets last year in 2018 when things were great. When we get into this year, we certainly move back to lower numbers. Most of the fleets want to add, no additions or 0 to 5%, or maybe 5 to 10%. So we definitely see people with lower, growth expectations this year, which makes it a little difficult, right? If you're that hired gun that went out and became a lone ranger last year and did your own thing, now all of a sudden the freight's dried up and the rates are bad, that fleet may not be looking for you right now because they don't really want to grow. They're in a similar situation. So I'm going to start off by talking about what the overall economic environment in trucking is. And, to do this, it's confusing for all of us today because we're in an information overload society. And so no matter what you look at, no matter what you watch, no matter what you listen to, you can listen to business news on satellite radio, you can read anything you want on the internet. And there's so much overwhelming data from housing starts to interest rates to unemployment numbers to automobiles manufactured. And it's really, I can tell you the smartest of the smart people. I get to hear a lot of them when I go to meetings, and nobody knows what's going on right now. You can hear one person say we're heading into a recession, and you can hear an equally smart person say things are great. We're going to have a fantastic next couple of years, no recession coming. What I really pay attention to, I think more than anything else, to try and drown out all that noise is I really believe in truckstop.com as well as the DAT. Both those load boards, have a huge number of loads on the internet. And so they publish gauges that kind of help us understand what's going on. So I'm going to focus on the truckstop.com market demand index. And just in simple terms, They publish every Monday in their newsletter. They publish a market demand index. And what they say is, I'm going to start off with the number of 12 because that's what I consider the break even for our industry. When things are above 12, they're good for truckers. When they're below 12, they're bad for truckers. So the Internet Truck Stop Market Demand Index, essentially what that says is for every 12 loads posted by a shipper or a broker on the internet, there's one truck looking for a load. So 12 loads to one truck. That's a break even ratio. So we can go all the way back to the Great Recession when we were down around 4 or 5. And then we can get into midsummer last year in July when we were at a ratio of over 70 loads per truck looking for a load on the internet. And so, if we look at a normal time, kind of back in mid 2017 when things weren't great, but they weren't bad in the industry. The average dry van rate was about $1.72 back then. We get into last summer when we were at the peak, and dry van rates were up all the way at $2.55 a mile, which is incredible. That's back when that's on average. So you definitely saw loads over $3 a mile. We get into today, and the average rate is around $1.80 a mile. So we've fallen all the way back to where we were pre, kind of the 28 boom time. The kind of crazy thing about it is we're still at a really high load to truck ratio. As of this week, that load to truck ratio is 34 loads per truck. So that tells me that really I think we should still be in a boom market, but it doesn't feel like we are. So something's a little bit out of whack. And I guess really what I'm paying attention to is where's this market demand index going next? It's been trading sideways at that 34 times for about 4 or 5 months. So, if it breaks out to the upside and we get up to 40, 45, that means things are going to be good. If it breaks out to the downside and we get in the 20s, that means we're heading into a negative trend. So I guess that's kind of where I'm at right now. But really what I'd say is based on that, I think things are just okay. They're not great like last year. They're not bad like the recession. They're just about average. Things are decent right now. They're not awful. So with that, I'm going to move into the ATBS specific numbers, and I'm going to talk about different segments of the industry. I'm going to talk about the independents, which are the trailblazers and the lone rangers. And then I'm going to talk about dry reefer and flatbed segments, which are those leased on to fleets that operate in those segments. But mostly I'm going to concentrate on an average of all those segments, just to give you an idea for an owner operator on average how you're doing. So I want to start off by talking about miles because at the end of the day, that's how everybody gets paid. I got to run miles to get paid, right? Even if you get a percentage pay, when you run miles, you get paid. So the kind of crazy thing is today, we're looking at data that starts in June of this year and goes back 12 months. So if you look at these, charts and pull up the presentation over the weekend after the team mailed out to you, when you look at the bar charts, the gold bars are 2018, the black bars are 2019, and then we have a whole year put together. Those are individual months being compared, and the whole year put together is on the far right of the slides. So as we stand today, looking back a year ago, we're driving 100,000 miles, which is 8,000 miles less than we drove annualized a year ago. So we've gone from 108,000 miles down to 100,000 miles. If you're in the flatbed business, you're driving about 83,000 miles a year. If you're in the reefer business, you're driving about 116,000 miles. Dry and independents, you're kind of in between that. Independents are about 88,000 miles a year, and dry vans about 104,000 miles a year. But remember what I said, miles are down, which is kind of weird. One thing that I'll say is last year, miles were down for owner operators, and it's the third time we've seen this. And when we look at a long-term chart, really the interesting thing is that in a robust economy, I would think that miles would be up. And I just relate that kind of to the average work in America. And when you talk to most people, when things are good, they work harder because they want to make more money. So as an example for me, I can tell you last year I was probably on a plane more than I have been in the last 10 years because things were great in our business and I could get more customers. So I worked harder. The opposite is true for owner operators. And really the reason I believe it is because as owner operators make more money, sure, they appreciate and they like the more money, but at the same time, they work really hard. They're away from home a lot. And so really what they really would like is some time off. They'd like to be, home with the family, taking a weekend off instead of driving. They'd like to watch their kid play football, go fishing, kind of enjoy life a little bit. And so we heard that last year. There was a lot of drivers, that didn't go out on Monday morning when they used to go out Sunday night. They took a little bit more time off, so miles were down. The other interesting thing, though, is I'm sure most of you are feeling it. Really starting early this year, rates have come down. Things are more difficult. And what I know about owner operators is they work harder than other drivers. The average company driver just does what they're told to do. Not that that's bad, but they turn down loads, or they say, I'm going to stay home today. I don't want to do this. I don't want to do that. Owner operators have got bills to pay. They got fixed costs. They got truck payments and insurance and home bills. And typically what happens is when things get tougher and rates go down, owner operators run more miles. We have not seen that trend yet this year, which is really kind of interesting to me. A lot of people can blame it on the EOBR and things like that, but I know even under an EOBR, you can run, or an ELD, you can run a lot more than 100,000 miles a year. So that's one thing that tells me things aren't too terrible right now. Otherwise, owner operators would be running more miles than they are. So that's one way, and we'll talk about it in a little bit. That's one way you can make more money is run more miles, obviously, if the miles are available to run. So the next thing we're going to talk about is revenue per mile. How much money do you get paid for the miles that you're driving? Our overall average right now is $1.58. So keep in mind, that's the drivers that are running for fleets. It's the independents. It's the load board. It's everybody. The average flatbed driver is making $1.97 per mile. The average independent's at $1.75 a mile. The average drive-in is $1.50, and the average reefer driver is $1.42 per mile. That's up 14 cents a mile, which is a great thing. That's a result of those rate increases that we took last year. So second poll question that we asked yesterday to the fleets that were on the line was, do you plan to pay a rate increase to your drivers this year? Are you going to give a rate increase? Last year, we had fleets given, anywhere from 1 to 3 different rate increases throughout the year. And those rate increases were 3 cents a mile, 5 cents a mile. It was a good year for everybody. This year, unfortunately, I've got bad news for you. Over half of the fleet said they don't plan to give a rate increase. Those that do plan to give a rate increase said it's between 0 to 2%. So it makes sense, right? We're in an industry where rates are flat to going down a little bit. And so, and the fleets, overgrew capacity last year, so they're not looking for a lot of drivers. So they're not going to increase rates. So if you're planning on making more money because of a rate increase today, this year, I've got bad news for you. It's probably not going to happen. So the next 4 slides I'm going to go through, even though you can't probably see the slides on the phone, are really important to kind of understand the spot market versus the contract market, which is what I'll call running for a fleet. If we go back to 2018 and we kind of look at the numbers, I'm going to describe a break even to you. So let's say today I'm driving for a fleet and life is good, and I feel fine about that. If I want to go out and run my own business, get my own authority, there's a bunch of stuff I've got to do. I've got to get a trailer. I've got to get additional insurance. I've got to book my own loads, whether it's through the load board, through a broker, through a direct shipper. I've got to collect. I'm going to have some bad debt. Plus, I lose some operational efficiency. I no longer have drop-in hooks where that fleet has a bunch of trailers parked and preloaded and those kinds of things. So we think that cost to go out there on your own is about $45,000 versus being leased to a fleet, which translates to about 42 cents a mile. And, through time, we've kind of seen that break even pay off. Back in 2014, we were above that break even. For sure, in 2018, there was about an 80-cent differential between me running for a fleet and me running in the spot market. And so let me translate that into real dollars. In 2018, I could run for a fleet and make about $1.50 per mile. I'm running 100,000 miles a year, so I'm making about $150,000 a year in revenue. I could go out and run the spot market on average for $2.25 a mile, which means same thing. I'm running 100,000 miles. I can do 225 grand in revenue. So I can make an extra $75,000 to $80,000 in revenue. It's going to cost me $45,000 to do that. So I'm to the good $30,000 to $40,000. A lot of drivers decided to take that risk and go make that happen last year and ran in the spot market. So let's fast forward to this year and see what's happening. Number one, I had to raise the break even. We went from $45,000 to $52,000. The reason we did that is the liability insurance has gone up tremendously for that new entrant or that single truck driver. In addition, really, it's gone up for everybody, even the big fleets. When we have these crazy verdicts from truck wrecks, like we've all read about and heard about, $75 million jury awards to and I'm not saying it's a good thing. It's really awful. People die in truck wrecks. It's horrible. But when you give the people that die and their survivors $75 million, insurance companies wake up and they freak out and they increase rates. And so the average liability insurance for, you out there on your own has gone from $5,000 or $6,000 to $12,000 to $20,000. So that break even's gone up to $52,000 or almost 50 cents a mile. The other bad news about that is when we look at spot market rates versus the rates running for the fleet today, there's a 40-cent differential. So again, let me put that in real dollars for you. let's just say it's still around $1.50 to $1.55 running for the fleet. The spot market on average, I'm going to make $1.80 per mile. And so in real world terms, that means running for the fleet, I'm going to do 150 to 160,000 in revenue. Running in the spot market, I'm going to do 180,000 in revenue. So it sounds good, right? I'm going to make an extra $20,000 in revenue. The bad news is I got to spend an extra $50,000 to go do that. So there's a net negative there of 30 grand. And so that goes back to what I said in the very beginning. That's why we see a lot of those people that migrated into the Lone Ranger, owner operator, own authority business now looking for a safe home, looking for a fleet that's willing to contract with them and give them some of that more consistent, lower paying freight. So that's kind of what's going on in the world today. And, you know, it's up to you. You've got to make the decision based on your business and the money you've got in the bank and all those kinds of things, what the best place for you to be is. I guess I'll, you know, just take a break and say for a minute, I really believe we overloaded the spot market with capacity. It wasn't just single truck drivers that left fleets and went out and got their own authority. You had humongous fleets with tens of thousands of trucks that realized the spot market was paying a ton of money last year. And they actually, you know, took trucks out of their long-term contracts with those big shippers, Walmart, Costco, all those folks, and they moved them in the spot market because they want to make great money too. So we literally flooded the spot market with way too many trucks. And that ending result was the end of last year and the beginning of this year was spot market rates plummeted. So we're kind of in that transition where we're moving a lot of those trucks back into long-term negotiated, you know, 3-year contracts with shippers at lower rates, but at good rates. And so, you know, we've got to work our way through that before the spot market becomes solid again. One thing I'll tell you, because I got asked this on the phone yesterday in the webinar, is in a time like last year, you can get your own authority, you can get your trailer, you can go run broker loads, internet truck stop, or DAT, and you can make really good money. In a time like now, it's very difficult to make good, solid, long-term money just running broker loads, just running, you know, spot market freight off of load boards. You really need to have kind of a head haul contracted, know a shipper, you know, and at least get half of your loads covered by a good long-term guaranteed kind of decent paying rate. So you know, as we go through a next cycle, because we have a lot of ups and downs in trucking, just think about that. When we go into the next cycle, you want to jump into the market, just make sure you've got a good long-term kind of solid head haul rate lined up. So we get to gross revenue, and the overall average driver, good news is it's up. It's $158,000 in the last 12 months, you know, up $2,800. If I'm an independent, my average gross revenue is $155,000. Dry van drivers 156, refrigerated is 165,000, and the flatbed is 165,000. So it's really amazing when you hear those numbers, you know, how relatively close they are. They're within 7% of each other. And so you hear a lot of drivers that move from the flat to the dry to the independent, you know, chasing the money. At the end of the day, you know, do what you like to do, haul what kind of freight you like to haul, because the opportunity's out there. Even though you might make high, you know, revenue per mile in one segment, you're gonna drive a lot less miles. You know, figure out what it is you like to do and stick with that segment of the industry, because you'll probably do okay there if you get to know it and you understand it. Fuel costs, you know, they've been pretty moderate. If we look year over year, they're just up a little bit, about 4 cents a mile. The average driver's spending right around 48 cents a mile on fuel right now. So I'm going to talk specifically about miles per gallon, because this is important right now. Even though we haven't had a spike in fuel, you know, and we haven't had a Hurricane Katrina that jumped fuel up over $5 a gallon or anything like that, fuel's over $3 a gallon, or it's right at $3 a gallon. One thing we saw last year, which was the first time we've seen it really in about 4 or 5 years, was miles per gallon actually went backwards. They went from 6.25 down to 6 miles per gallon for our average client. And we thought we might have had messed up data there for a little bit, and we dug into it. And as we kind of understood it more, what we really figured out was last year, you know, every one of you that are on this call, all of our clients, we changed our mindset and life became about revenue. We were chasing revenue last year. And so we drove really as fast as we legally could for the most part to get to that next load, because that next load paid great money. And we really forgot about managing our fuel costs. Probably didn't even pay attention to idle time that much because we were making good money. And it happens not only with individual owner operators, it happens with American business in general. When times are good and things are great, we forget about costs. We focus on growing our business. We focus on investing in the things we need to invest in. We kind of forget about the cost side of the business. And so if I can do nothing else today than help you understand that the world's changed, we can't chase revenue like we did last year. It's more important to think about the cost side of the business. Let me just help you understand, one simple thing. If I save $1 in my business, that dollar falls straight to my bottom line into my bank account. If I generate $1 extra of revenue, I actually have to pay money to generate that revenue. I got to spend money on fuel and maintenance and my variable costs. And so only probably 40 cents of that dollar goes to my bottom line. So this is a year, because revenue is not high paying. This is a year to focus on the costs. The good news is we started spreading that message early in the year in the webinar that we did in March, but also with our drivers, on a regular basis. And y'all are listening, because we have fuel economy almost even today. It's back up to 6.5 miles per gallon. And so y'all are focusing on fuel economy. I can tell you that simple differential of going from 6 miles per gallon to 6.5 miles per gallon, that average cost savings is $5,000 for the average driver. $5,000 directly in your pocket. You don't have to spend any money to save that $5,000. Sure, you might be driving, 62 or 65 instead of 70, which isn't as enjoyable. But at the end of the day, does it really matter? That's the decision you got to make every single day is, do I need to drive the speed limit to get to my next load and make delivery so I can get to the load after that? Does that make sense? Or do I really have time? Can I slow down, and can I drive 60 and take a little bit of extra time and, save $100 or $200 on this load in fuel? I guess I'd say the last thing about fuel is you became an owner operator for a reason, and that's so that you could react to what's going on in the market and make your own decisions every single day. If you're a big truck line and you own 1,000 trucks and you realize the market's changed and we need to save money on costs, for you to slow down your trucks, and lower that governed speed limit from 67 miles an hour to 62 miles an hour, that takes you a year to get all those trucks through the shop, govern them, try and manage the drivers. As an owner operator, I can make a decision this afternoon. Let's just say rates pick up. Let's say something happens and rates go up by 20%, in the next 3 months for whatever reason. Things get great. Again, you can change your mindset and you can say, fuel doesn't really matter again anymore. I'm going to drive as fast as I can to get to that next load. So right now is the time to pay attention to your costs. Enough said on that. You guys are smart enough to figure that out. So the last slide I'm going to talk about regarding fuel is, we've already talked about revenue's gone up 14 cents per mile. Costs of fuel went up 4 cents a mile. So the good news is there's a true net good of about 10 cents a mile based on the rate increases that we got last year. I'm going to talk about truck payments for just a minute to kind of give you a gauge. Our average client is paying $2,400 a month for a truck right now. That's probably a good average used truck that might be 4 or 5 years old, 500,000 miles on it. We've got clients that have brand new trucks that are paying over $3,000 a month. We've got clients that have trucks that are 15 years old that they rebuilt the engine on 3 times that are paid off. But on average, our clients are paying about $2,400 a month for a truck. That's up a lot from the last 15 years. Trucks used to cost $1,700 a month. And, the average truck went from costing $90,000 to over $150,000 today. The biggest reason for that is the EPA mandates. As we all know, the government requires the trucks get cleaner. It's probably a good thing at the end of the day, but it's expensive. Those electronics and all the stuff that make that happen cost more to maintain, and they add cost to the truck. On average, our average client spends about $11,000 a year on maintenance. And, I guess I'd tell you, whether you got a new truck or a used truck, if you set 11 cents a mile aside, that covers all maintenance. That's not just preventive maintenance and tires. That includes over the life of my truck, a long-term, overall of my transmission, my engine. Set aside 11 cents a mile, and that should take care of your cost for maintenance. But if you don't do that, the bad news is, as we know, you're going to at some point have a hiccup with your truck, and it's going to cost you a few $1,000s or maybe many thousands of dollars. If you don't have that money set aside, it's the number one reason that our clients go out of business and stop being owner operators, is they have a catastrophic maintenance event and they don't have the money to take care of it. So set that money aside for maintenance. So I'm going to move now to net income. What really matters at the end of the day is how much money you make. Our average client this last year, rolling 12 months, is at $64,700. It's off from the end of the year when they're at $65,000. So it's down a little bit. And I'm going to talk at the end about the first 6 months of this year versus the first 6 months of last year, but that's a rolling 12 months. So that's good news. There's one bad piece of this puzzle when you look at the slides, and we're looking at the independent, dry, reefer, and flat. Everybody's up independent, dry, and reefer, but the flatbedders are negative. And so I'm not saying if you're in the flatbed business, run and get out of business, but I hate to see the flatbed business negative net income year over year. Really what that tells me is the way we look at the world is flatbedders lead us out of recession. They also lead us into recession. When we think about what moves on dry vans and reefers, it's typically consumer goods. It's things like, beer and meat on refrigerated trailers. It's clothes. It's, toilet paper and paper towels and all that kind of stuff on dry vans. They get used pretty quickly. They stock shelves. What moves on flatbed is more industrial goods like cranes and tractors and steel and things that people are looking at long-term investments. And so, when flatbed is good, that means that people have a good long-term. We want to build buildings. We want to build houses. We want to buy tractors because, we're going to be growing crops and we need to replenish our tractor fleet and stuff like that. When that slows down, it means that people are probably looking at, maybe the economy is going to slow down. And so maybe we should stop investing in those long-term infrastructure things. So again, just, one way to get a glimpse into the future besides all the economic news that we hear is I believe that negative flatbed net income number going down tells us that long-term, the next 3 to 5 years, things are going to slow down, and they're due to. We've had a good couple of years in trucking. So I'm going to just kind of wrap up here near the end talking about some long-term trends with net income. And a lot of times I know we get frustrated, especially on the road, when we look at our net income and we're in a cyclical business and things start to go down. And I can tell you we have our ups and downs, but if I look at the long-term trend over the last 15 years, the good news is the average owner operator has gone from making 35 cents a mile to making close to 70 cents a mile. As far as monthly net income, they've gone from making about $4,000 a month to making close to $5,500 a month. So long-term, it's a good trend. It's a good industry you're in. It's a good segment you're in. Trucking's not going away. And so I like that. On the next slide that I'm going to talk about, I like to compare the work versus the pay. So how hard do I have to work versus how much money am I going to make? That's kind of the question everybody in America asks themselves is how hard do I have to work for how much I'm going to make? And we've talked about the numbers, but just to, bring them to light for you, the miles have gone down. Our average driver back in 2003 ran 139,000 miles. And a lot of you on the phone are probably laughing because you think back on those days when you had 3 logbooks and, you were gone 5 weeks at a time and you just drove. That's how you made money. Today, you're running 100,000 miles. That means we're running over 30% less miles today, but our income has gone from $47,000 15 years ago to $64,000. So it's up 35%. And, I get emails and I get arguments that, that doesn't even keep up with the cost of inflation and those kinds of things. And to some extent, that's true. But the good news is at least that the miles are coming down, the lifestyle's better, I get home more often, and the income's going up. So I guess for me, what that really means is the long-term trend of the owner-operator business model is a good one. Less miles for more pay at the end of the day is a good thing. And I think we'll continue that trend. So I'll give you the last poll question that we asked yesterday to the fleets. And we started asking this a few years ago in 2017, really when we felt those political winds very strongly against the owner-operator model. So the question is, given the current political and economic environment, are you optimistic on the independent contractor model? And I can tell you the good news is that 80% of the folks that answer are either very optimistic or somewhat optimistic on the owner-operator model. So that's a good thing for all of us. Again, goes to reiterate that what you do, is a good thing. So I'm going to wrap up with just a few comments to kind of tie everything we've talked about together. One thing that is really important for you to realize, because I think it's easy to get down on yourself, down on your work, down on your job when you feel like you're making less money. Our average driver in the first 6 months of 2019 versus the first 6 months of 2018, net income is off only $25, less than 2%. So put that in perspective. If you're making a net of $1,200 a week, maybe even $1,500 a week, and that goes down by $25, it's almost negligible. $25 is $25 to anybody, but at the end of the day, that's a cup of coffee a day. That's 1 mile per gallon. That's going from 67 miles an hour to 66 miles an hour on your odometer. It's 2 lunches a week at the truck stop. You can save that money by doing a few things. So that's not really terrible, even though things have slowed down, even though the spot market's way down. On average, things aren't terrible. What's really interesting is miles are off by 150 miles a week. That's 7%. And really what I think is, from a truck driver's perspective, when I'm not running as many miles, I don't feel busy and I feel like I'm not making money. Even though net income's not off, my miles being off make me feel like I'm not making money. So one thing I'm going to reiterate to you to really think about is what you do when loads are offered to you. whether you're in the spot market dealing with brokers, whether you're running for a fleet. Last year was a time we could be choosy. We could turn down loads for pay. We could turn down loads. I live in Colorado, and September 1st, they put the sign on going west. Chain law in effect, truckers must have chains, right? We're going to start having snowstorms. And, honestly, when I drive home at night and I go up that mountain pass and I look at truckers, I think, why in the world would somebody spend an hour out there chaining up their truck to drive 20 miles to get up I-70, into the foothills and then have to take the chains off? And so a lot of truckers choose not to do that. And that's your decision. But the one thing I'm saying is we're in a time where there's not as many loads to be choosy about. Maybe you're going to have to take a load to go somewhere that you don't want to go. But remember, as an independent contractor, you've got fixed costs to cover. If you own your truck with some debt payments, typically your fixed costs on a weekly or on a daily basis are about $150 a day. You have home costs to cover. You might have rent, you got a wife and kids maybe. Your costs at home to take care of are about 150. So your fixed costs are between $250 to $300 a day. If I sit today because I don't like the load, I don't like what it pays, I don't like where it's going, I just dug a hole for myself of $250 to $300. That means tomorrow I've got to make that up. So again, we got to change our mentality and our mindset to go from a year like last year when we could be choosy, we could do whatever we want, we could hold out for that $3 a mile load, to today, take the loads that are out there, make good sense, but cover your fixed costs. I'm not saying don't be dumb and don't go out there and run a bunch of 85 cent a mile loads, or don't take things that are going to delay you when you're delivering for 48 hours. You still got to be smart about what you haul, but you just can't be as choosy about what you were last year. Remember what I said about the cost side of your business. This is a year to focus on costs. Negotiate your maintenance, plan ahead, tell the dealer or the place working on your truck, you know what, this is a tough year. I'm not doing as well as I can. Can you give me a 10% discount on parts or service or something like that? But most importantly, what you can control every single day is your fuel costs. So, you can go to ATBS.com. We've got 100 ways to reduce your fuel costs out there. If you Google fuel costs, you guys know a lot of them. Slow down, don't idle, but there's a lot of simple things you can do beyond those. And the last thing I'm going to say to you is, I grew up, my grandpa was a farmer in Colorado, and I got to spend a lot of summers with him, which was awesome. I love spending time on the farm, but my grandpa was a German and he was a tough old guy. And the thing I learned about farmers is they never have a perfect year. They either have too much rain, they don't have enough rain, they get the crops in and it doesn't rain and they don't grow, so they don't grow enough crops, or they get too much rain and they can't get out in the field and harvest the crops. But the one thing my grandpa said is we find a way to survive year to year. And his motto was that tough times don't last, tough people do. And so I want to leave you with that, because you chose to own your own business for a reason. You chose to be that tough person that's going to go out there and make it on your own. You're not going to count on someone else doing your loads for you and someone else telling you what to do. You're an independent contractor. You make your own decisions. So sure, we're in a little bit tougher time than we were last year, but it's by no means the worst time we've ever had. To be honest, it's not even a bad time. It's an okay time. So I want you to, get that mentality of, I'm going to be tough. I'm going to go out. I'm going to make good decisions. I'm going to work hard, because I truly believe you can make as much money this year as you did last year if you do the right things. You just got to pay attention to the business. So with that, I'm going to wrap up. I really appreciate y'all being on the phone call. Appreciate you being customers of ATBS. I say, God bless you. Drive safe. And thanks for moving the freight around the country. Take care.